Earlier this month, the price of Bitcoin dropped by nearly 30% in a matter of days. This drop put most altcoins in freefall, with some losing more than half of their value during that time. Nearly $400 billion was shaved off from the total crypto market cap as a result. Now this is called the dip, and it's something that you're told to buy by many crypto memes and experienced crypto traders. However, buying the dip is much easier said than done. This is because there's no way of knowing for sure where the bottom is when a cryptocurrency dips, and the answers you get are always different depending on who you ask. That's why today I'm going to tell you everything you need to know about the dip. What it is, what causes it, how long it's likely to last, and how to confidently buy the dip on your own using this knowledge. Before we head for all-time highs, there is a disclaimer I need to supply. Financial advice is well and good, but if you're looking for it here, you're in the wrong neighborhood. I'm not a financial advisor, and I don't even have an FCA degree. When it comes to educational crypto content, however, I have a triple PhD. If this is your first run-in with the Bureau, my name is Guy, and I am a crypto superhero. I keep no-coiners and moonboys at bay with the highest quality crypto content you'll find on YouTube today. Crypto news, crypto reviews, and crypto market moves are just a few of the topics in my tool belt. If you want to join me in my crypto quest, subscribing to the channel and pinging that notification bell is the way to do it best. Note that I've left timestamps in the video timeline that you can use to get around if you're feeling stretched for time. Of course, I'd appreciate it if you watch the whole way through because it will help this video get even more views. Forget your FUD and FOMO, let's dive into the dip and all the things you need to know. The first step to mastering the dip is understanding what it actually is. In cryptocurrency, the dip is defined as a sudden and sustained drop in price. This is a vague definition because whether or not a cryptocurrency is dipping really depends on its general volatility. During a bull run like the one we're in now, it is normal for Bitcoin's price to go up or down by 5% per day, or go up or down by 10% or more on a weekly basis. For altcoins, it's normal for their prices to change by more than 10% per day, and they can easily gain or lose more than 20% of their value each week. If this is the price action you see, this means the crypto market is trading sideways and is in a no-trend scenario. In other words, prices aren't really going up or down. Now, if Bitcoin suddenly drops by more than 5% in a day, or an altcoin drops by more than 10% in a day, this could mean a dip is beginning. Normally, you'll know within a few days whether it is an actual dip or just extra market volatility. If it is a dip, this can signal one of two things: a temporary correction in a bull market or a crash that results in a bear market. Naturally, people who are bullish on cryptocurrency will generally adopt the correction narrative, whereas those who are bearish on crypto will insist that it will crash down to zero. The easiest way to check this for yourself is to pop open the price chart of the cryptocurrency you're looking at on CoinMarketCap or CoinGecko. Set the time frame to 1 year and try and spot a long-term price trend. Now, if you see that the price has been consistently trending up over the last year, this dip is probably a temporary correction. If it looks like the price is trending down or has reversed from an uptrend to a downtrend in recent months, this dip could be the beginning of a long-term crash. As you can see, Bitcoin's recent dip was nothing more than a temporary correction on a longer-term uptrend. Bitcoin has had around 4 major corrections so far since the bull run began last spring, and all of them have been within the 30% range. To put things into context, corrections in Bitcoin's previous bull runs were usually over 50%. The reason why they're not as extreme this time around is probably because institutional investors and experienced retail investors have been buying the dip. Bitcoin's volatility has also been declining over time as adoption increases, and the mass adoption we've seen just over the last few months means it's very unlikely that Bitcoin will be crashing anytime soon. Now, you can learn all about that by watching my recent video about CoinGecko's quarterly crypto report. Link is hanging up there in the top right. So, now that you know what the dip is and how to spot it, the next step is to figure out what could be causing it. This is important to know if you're trying to buy the dip, because looking at the price charts alone might not give you enough context to make the right call. For example, if one of your favorite shitcoins is crashing because it's turned out to be a scam, no amount of technical analysis is going to help you buy that dip, because it's just going to keep dipping. By contrast, if Ethereum suddenly drops because there's news that miners are going to try and disrupt the network in protest of EIP 1559, then clearly this will require a more elaborate buy the dip strategy. The problem with identifying causes in crypto is that it's very rare that you can definitively point to a single factor. Usually, there are multiple factors causing a dip, and each of these often cause overlapping chains of events that can turn into a vicious feedback loop. Let's use Bitcoin's recent dip as an example of what I mean by this. As far as I can tell, the dip in mid-April was caused by a barrage of bad news. For starters, on April the 15th, Turkey announced it would be banning cryptocurrency payments. Now, this probably spooked quite a few new investors who might have gotten the impression from certain news outlets that this is the beginning of some larger movement by governments to ban cryptocurrency. Since cryptocurrency investors are located around the world, not all of them got this news at the same time. Within about 24 hours, all the newbies knew what was up, and their panic selling was in full force. The sudden drop in price this caused resulted in reckless traders using too much leverage getting liquidated on futures exchanges. In plain English, the BTC these traders used as collateral to borrow from exchanges to execute these risky trades was automatically sold onto the open market. This is what caused that huge wick you see on the bottom of the big red candle on the Bitcoin chart for April the 17th. In this case, the wick was created by all the traders who had set buy orders for BTC in that price range. These orders were filled by all the BTC being sold from over-leveraged traders. Prices stabilized for a couple of days and then dropped again when the news came out that the current US administration was looking to increase corporate and capital gains taxes. An increased corporate tax would mean less profit, and less profit translates to lower stock prices for all the affected companies. An increased capital gains tax would mean that any wealthy investors who have already cashed out some of their gains this year will probably need to sell more assets to pay for the taxes on those gains. The combined effect of both factors led to a dip in both the stock market and the cryptocurrency market, where it again triggered liquidations from over-leveraged traders, though to a lesser degree. Now, I have to stress that this is a simplified explanation of the causes and chains of events behind the recent dip, and there were probably way more moving parts at play in the background. Now, if you want to get a closer look at why Bitcoin pumps and dumps, you can watch my video about that by using the link in the top right. Now that you know what the dip is, how to spot it, and all the factors that cause it, the next step is to understand how this relates to altcoin dips. As many of you already know, altcoins are highly correlated to Bitcoin. Now, this is important to remember during dips because no amount of bullish news can save your altcoin if Bitcoin is in freefall. Sometimes there are exceptions to this rule, but I have yet to see a single altcoin that has sustained its price across multiple Bitcoin dips, not even stablecoins. More importantly, remember that whenever Bitcoin dips, altcoins will usually dip harder. This is because in the context of cryptocurrency, Bitcoin is seen as the safe haven and altcoins are seen as risky investments. You can track how money is moving between Bitcoin and altcoins using the Bitcoin dominance chart. As you can see, Bitcoin dominance spiked during the recent dip. However, as with price, you can see that the longer-term trend is towards lower Bitcoin dominance, aka more money moving into altcoins. This means that whenever Bitcoin dips and decimates altcoins, the profits you'll get from buying the dip will be even larger for altcoins. This is because they will rebound much more aggressively than Bitcoin once it finishes dipping and BTC dominance returns to its downtrend. Case in point, during the relief rally last weekend, Bitcoin went up by about 7%, whereas many altcoins went up by 15% or more. Pro tip: don't be discouraged if your altcoin doesn't pump right away after the market is done dipping. If you can see that your altcoin has been in a visible uptrend on the 1-year time frame, it's probably a matter of time before that pump comes your way. You can get a sense of when that pump might happen and how high it could take your favorite alt by using technical analysis. Now, technical analysis is much easier to do than you think, and this crypto champ happens to have a beginner's guide in my intro vid to TA. Now that you know what the dip is, how to spot it, and all the factors that cause it, and how it impacts the altcoin market, the last step is to measure how low the dip could go. Again, a lot of this will depend on the factors that are causing the dip, and there is no way of knowing for sure where the bottom of the dip actually is. However, there are no shortage of tools you can use to estimate how deep a dip could get, and all of these can be found on the trading terminals of your favorite cryptocurrency exchanges. If the entire crypto market is dipping, then your main area of focus should be the BTC USD chart, even if you don't hold any BTC. This is because of that Bitcoin-altcoin relationship I mentioned moments ago. Start by going full screen, removing all the indicators and setting the time frame to weekly. This will give you some perspective about what could happen in the market in the medium term. The first thing to look for is any price zones that could serve as support if the price were to fall any further. In this case, it's quite clear that the 49K range is a strong zone of price support for BTC. Next, enable the EMA indicator. This stands for Exponential Moving Average, and it helps identify any other zones that could serve as support that aren't immediately apparent. In this case, the EMA suggests that if BTC were to drop again, the next zone of support would be around 42K. This means that if you wanted to buy that dip, you would be trying to buy somewhere around that 42K range. Remember that the price could drop slightly below this level because of things like liquidations. If this dip were to happen, it would correspond to a 20% drop. You can measure this using the ruler icon in the TradingView tab of the trading terminal on the Binance exchange. Full tutorial to use this exchange is in the top right, by the way. Because altcoin losses can be almost twice as big as Bitcoin losses during a dip, this would translate to a 30 to 40% dip for your altcoin holdings. So now that you know what the bearish scenario is in the medium term, you can get a better sense of what to expect in the short term by using the daily time frame. The daily time frame typically offers the best vantage point for buying the dip. As with the weekly time frame, the first thing to look for is visible signs of support. The way to spot these zones of support is by looking at where prices have clustered in the past, and this is often much easier to do on the daily time frame. As you can see here, the 49K range is showing itself as a strong zone of support, and the next level below that seems to be around 46 to 47K. Now you can start adding indicators for more context. Starting with EMA, you can see that the 100-day EMA is a strong zone of support, and it's worth pointing out that it has been a strong zone of support during previous bull markets as well. Adding the Bollinger Band indicator reveals that we are almost outside the volatility cloud. Now, as a rule of thumb, buying when prices fall below the cloud and selling when they poke above it is usually a safe bet. The next indicator to check is the Relative Strength Index, or RSI. This will show you whether Bitcoin is overbought or underbought. As you can see, Bitcoin has recently had a habit of falling down to the underbought level before spiking up. This happened again after the recent dip, which saw the RSI drop all the way down to just 13 points. When you combine the EMA, Bollinger Bands, and RSI, you should get a clear picture of whether you're at the bottom of the dip in the short term. In this case, the bottom of the dip was on the 24th of April, because that is when the price closed at the 100-day EMA, fell below the Bollinger Band volatility cloud, and fell low on the RSI indicator. Now for the real question. Is the dip really over? Well, there are two ways you can check this. First, enable the MACD indicator and see if it suggests a trend reversal. Specifically, you're looking to see if that wave of red bars is starting to shrink back to the midline. This seems to be happening here. The second way you can check if a dip is over is by analyzing trading volume. What you're looking for is a gradual decline in sell volume and a gradual increase in buying volume. The caveat here is that you must remember that a lot of the sell volume you're seeing is coming from liquidations from over-leveraged longs. Cancelling out that noise seems to suggest that sell volume is on the decline, but in this case, it is not entirely clear even after accommodating for liquidations. However, every other indicator seems to be suggesting that the bottom of this dip is in, and that Bitcoin will be trading sideways or gradually moving upwards over the next few days. In both cases, you should keep your eyes peeled on that Bitcoin dominance because it will confirm whether the crypto market is feeling bullish enough to move back into altcoins. If the market dips again, then you'll know what zones to watch for, and you'll be able to calculate how low your alts could go in those scenarios by multiplying Bitcoin's percentage drop by 1.5x to 2x. If you're wondering where prices are headed to next after a dip is done, you can follow the steps I detailed in my previous video on technical analysis, and it is in the usual spot. As much as people talk about buying the dip, it's something that's seldom done, and I think that's for two reasons. First, buying the dip can be a very scary thing. There's no way of knowing for certain if it's a correction or a crash, mainly because the factors behind each dip are often hard to pin down. However, I'm of the belief that people fear what they don't understand, and the dip isn't any different. With enough context from the media and the charts, chances are you'll get a pretty clear picture of where the market is headed in the short term, medium term, and long term. The second deterrent to buying the dip is a lack of cash on hand. Now, I blame this on the fact that too many crypto traders forget to take profits when the market is moving upwards. The whole point of doing this is to make sure that you have the fiat firepower to buy the dip when it inevitably comes. Similarly, fishing for the bottom of the dip is often a futile endeavor. Keeping track of the next possible zones of support is critical because you might encounter more than one dip in the medium term. After all, nothing goes up forever, and corrections are to be expected from time to time. Now, these can really suck, but they are necessary for Bitcoin and altcoins to reach their full potential during this bull run. Dips shake out the weak hands and the greedy traders who would cause a serious crash if left unchecked. The hodlers are traders that remain with a long-term vision, the growing minority of people who know that the current financial system is on the cusp of a serious transformation. So whenever the dip gets you down, keep this bigger picture in mind. There's no guarantee you'll get rich from crypto even if you do buy the dip, but you'll probably have more money than if you'd kept your funds in fiat currencies that are losing their value by the day. Just keep calm and hodl on. If you enjoyed today's technical analysis tutorial, take a second to smash that like button. Remember to subscribe to the channel if you haven't already, and ping that notification bell to get a nudge when the next video is ready. In the meantime, you can follow me on Twitter, TikTok, and Instagram to get my real-time reactions to crypto news and get an exclusive behind-the-scenes view. My free Telegram channel is also filled with more market updates than you can handle. These complement the tools, tips, and tricks I tell you about in my weekly newsletter. And I bet you're wondering where I got this awesome hoodie. Well, the Coin Bureau merch store is where you'll find this and more, and you can find your way there by using the links in the video description just below my subscriber score. That's it for today, my crypto friends. Thank you for watching, and I hope you come again. Goodbye until then.